Ever heard of making money when stocks drop? While most of us aim to buy low and sell high, there's a method that flips this on its head. Welcome to the world of short selling. Welcome to our channel. Today we're unraveling the concept of short selling, a strategy where investors can profit from falling stock prices. It might sound strange and a bit risky, but it's a common practice in the stock market. We'll guide you through the process, explain the risks involved, and highlight why some traders choose this path. Whether you're new to investing or just curious, understanding short selling will give you a valuable edge. In this video, we'll demystify the process of short selling by breaking it down into simple steps. We'll explore why traders short stocks, the potential risks like unlimited losses, and the concept of short squeezes. Plus, we'll discuss alternative methods for betting against a stock without diving into full-blown short selling. Stick around to arm yourself with essential knowledge that can help you make informed investment decisions. Short selling, a concept that flips the traditional stock market strategy on its head. While most of us are accustomed to buying shares hoping they will increase in value, short selling allows you to profit when a stock price goes down. But how exactly does this work? To put it simply, shorting a stock means you borrow shares from a broker and immediately sell them at the current market price, anticipating that the price will decline. Once it does, you buy the shares back at the lower price, return them to the broker, and pocket the difference. This method sounds counterintuitive and risky, but many traders use it to their advantage. Let's walk through the short selling process step by step. First, you identify a stock you believe will drop in price. Next, you borrow shares of this stock from your broker. You don't actually own them. Then, you sell those borrowed shares on the open market. You're now hoping for a price decline. If your analysis was correct and the price falls, you purchase the shares at this lower price and return them to the broker. Your profit is the difference between the selling price and the buying price, minus any fees. However, the risks of short selling can be significant. If the stock price increases instead of decreases, your losses could be unlimited, as there's no cap on how high a stock's price can soar. Why would someone choose to take this risky path? Traders might short stocks because they suspect a company is overvalued or as a strategy to hedge against other investment risks. It can also be used as a tool to keep market valuations more accurate by highlighting companies that may be overhyped. Despite the allure of potential profits, short selling comes with substantial risks. The possibility of unlimited losses, margin requirements, and the threat of a short squeeze are weighty considerations. A short squeeze occurs when a heavily shorted stock unexpectedly rises, prompting short sellers to buy back shares to avoid further loss, thus driving the price even higher. The GameStop saga of 2021 is a prime example of this phenomenon. The pros of short selling include the ability to profit from bear markets and helping maintain market balance by challenging overvalued stocks. However, the cons significantly weigh on this decision. From the complexity and high-risk nature of the actions required to the potential for emotional and financial stress, it's a strategy best left to experienced traders. If you're a beginner investor, short selling might not suit your risk tolerance or experience level. But understanding this concept is valuable, even if you decide never to engage in short selling yourself. It broadens your perspective on how market mechanisms work and why some stocks might behave unpredictably. For those intrigued by strategies that profit from price declines but are apprehensive about the risks of short selling, alternatives do exist. Consider put options, which grant the right to sell a stock at a predetermined price, limiting losses to the premium paid for the option. Inverse ETFs offer another route, designed to increase in value as markets fall, providing a buffer against downturns. These strategies offer ways to hedge investments without fully diving into the high-risk realm of short selling. Ultimately, keeping informed and carefully weighing investment decisions against your risk preferences ensures that you remain a savvy participant in the dynamic world of stock trading. To recap, short selling is a strategy where investors sell borrowed stocks, hoping to buy them back at a lower price. It offers the potential for profit when markets decline, but comes with significant risks, like unlimited losses and margin requirements. We also discussed alternatives like put options and inverse ETFs for those looking to bet against stocks more safely. Understanding these can enhance your investing toolkit. Now that you've learned about short selling, what are your thoughts on using this strategy in your investment journey? Have you ever considered short selling, or do you prefer other methods? Share your experiences or questions in the comments below, and don't forget to subscribe for more insightful investing tips.